Right, a lot's changed since you and I started in the business. Is there opportunity? Where is it at today? And kind of what do you see people should be taking advantage of in the current market?
A lot of people comment that they wish they would have bought more in 2008 or those types of times. And sometimes when you're in those moments, it's hard to appreciate or realize the opportunity that exists there. 5 years from now, 6 years from now, people are going to wish that they had pulled the trigger on some of them to get in.
What are kind of the big benefits of investing in real estate versus maybe some other asset classes? Someone's just getting started in real estate today. What's your best advice to them?
One thing I think.
Welcome back, everyone, to the Apogee Wealth Podcast. I'm really excited about today's guest, and some of you may already be familiar with him. He's one of my business partners who's participated in almost every commercial real estate project that we've done. So we've been longtime partners, friends, very experienced investor, not only with multifamily, but other residential asset classes as well. So super excited to have him on the show and see what we can learn today. Marcus, welcome to the show.
Yeah, thanks, Jonathan. I appreciate you having me and sharing your space with me.
Awesome. Well, I know that probably myself, many of the listeners know who you are, but there could be some people listening who don't. You want to give us just a brief introduction of background, who is Marcus Long, and how did you come to be an investor in real estate?
Yeah, absolutely. First, I always like to kind of lead off with, I'm a husband and a father, and those have and continue to drive a lot of the decisions that I've made to this point and going forward. So kind of going back, I grew up in a rural Missouri farm community. I joined the Navy right out of high school. A little bit later, got selected for a commissioning program and went back to the University of Missouri, where I got a finance degree. And I didn't know it at the time, but that was really, part of the beginning of my real estate journey. Because I was 22 years old. I bought a property there to live in while I was in college, and kind of house hacked it before I think that was a term. And then when I graduated and left, went back to the fleet, I kept that as a rental property. And so that was really kind of the beginning of the journey. And over the course of most of the next 21 years of my naval career, I started just slowly accumulating single family rentals. And while I moved around a lot, most of those were actually back in Missouri, many kind of in the community I grew up in. And as I got closer to the end of, that 21-year career, I was kind of had a lot of conversations with some of my peers and, talking about why I was leaving the military at the time that I was, which was largely driven, by my children and wanting to be present with them and available. And it kind of got me to thinking about how many of them depended on or felt safe, with that secure paycheck all the time, every couple of weeks, and kind of limited options that a lot of people have. And so it really drove me to what did I want to do after the military. I enjoyed real estate, and that's kind of when I made that transition into multifamily about 2020, a couple years before I was retiring. There's a lot of benefits from a economics perspective, but it also gave me an opportunity to educate, provide knowledge, and share opportunities with some of that network as well. And so here we are today. I left the military about 3.5 years ago, focus on multifamily full time, and live here with my family in south of Kansas City.
That's awesome. And, just because I know this story, and you can elaborate on this as much or little as you want to, but what did you do during your time in the Navy? Just because I happen to think it's particularly interesting.
Yeah, so I was a cryptologic warfare officer, and so got to do quite a few pretty unique opportunities, from signals intelligence in the fleet to working at the aerospace data facility out in Colorado. And finally, in the very end, my last duty station was actually in England as an exchange officer for U.S. Cyber Command.
Very cool. Yeah, and so Marcus and I actually met during COVID. For those of you that were investors during that time, you might know there wasn't a lot of meetups or conferences, but there was a lot of online Zoom type of meetups. And so we met through some mutual friends during that time, and had the opportunity to partner on one deal, and then did more deals. I don't even know which one we're on today, but probably 10th if I had to guess, something like that. So yeah. I've done quite a few deals together. One thing I'm interested to ask right off the bat, Marcus, just because I think a lot of the listeners will want to know, there's many people out there that, they go buy one or two single family, or, maybe they put some money into a syndication project passively, which is obviously great for folks like ourselves. But there's not a lot of people that take this step beyond that, which might seem like a big step of, hey, I'm going to be an active partner in real estate and go buy very large commercial properties. What kind of thing or things helped you to go from that? I don't want to say a smaller investor, because obviously people have done really well with individual single family, but from that smaller real estate portfolio to the larger one, what were kind of the key things that helped you make that jump?
Yes. So as you mentioned, we met through virtual stuff. And shortly before that, before we met, I had joined a mastermind group focused for active duty and veterans. And up until that point, I had primarily really only knew like long-term rentals and stuff. I had Airbnb, a room in the house, and a couple other things, but I wasn't as familiar with syndications and some larger investments like that. However, when I joined that group, I connected with a couple of other investors that were doing that, and I actually passively invested with some of them first. Kind of got more familiar with multifamily and syndications through that, and it was kind of around the same time, that I was, like I said, I was 2 or 3 years out from retirement and starting to try to build that runway of what I was going to do post-military career. So that's one thing that kind of opened my eyes to multifamily. And as I mentioned, when I started having some of those conversations, you realize that there was a lack of knowledge. I knew if I didn't know about certain things, even though I'd invested in real estate for 15 years at that point in time, I wasn't familiar with it. There's probably a lot of other people that weren't familiar with those kind of opportunities and stuff as well. And so as I left the military, I still had this desire to serve, to give back in different ways. And like, that was one thing that kind of, I had always used either my own money, or my brothers and I had partnered on some single family stuff, but had never really used like private lending or had investors in syndications. Hadn't really partnered with others. And so it just kind of started things, fell into place, I guess, from a perspective of, growing the real estate portfolio and seeing an opportunity to serve others through that as well.
Cool. That's fantastic. One thing that I think you're probably particularly qualified to talk about, because you've partnered with Paula and I on a number of deals, and I know a number of other great sponsors as well. But I think one of the questions people have coming into this arena is how to partner with people, how to find good people to partner with. In the single family world, at least I know you did some stuff with your brothers, but Paula and I, we did everything on our own. We'd buy the property on our own, figure out how to get it renovated and get the loan, did everything solo. But as most of the listeners probably already know, in the commercial space, that's rarely the case. You usually see large deals done in partnerships. And so how have you become competent in meeting people and learning who you want to partner with? And how would you recommend that someone go out and vet potential partners if they're interested in buying deals?
Yeah, and I think bringing up partnerships and stuff is also probably kind of goes back and answers the last question a little bit too. Multifamily is very much a team effort, and we all have different skill sets and interests and stuff, and so it's very challenging to do all of that alone. And finding the right partners that complement your skill sets and that have the same values and stuff is a big part of making that jump into to doing larger multifamily stuff as well. And I think that my brothers and I actually learned a lot. Probably we had the best of intentions, when we started buying some of those single family, but a lot of us had other W-2s or were military. A lot of us didn't live nearby or close. And when we kind of started that, it was kind of everyone was equal percentage. And, we had some kind of roles, but not really as defined as like you and I and Paula and stuff do in our teams today. And a lot of times it was kind of who's available at the time or who has some extra time to do it. And what you realize is that there's times that we're all busy and you're waiting on someone else to do it and stuff. And so I think that experience that we had together also helped me a lot as I moved into like larger things, and the importance of having defined roles and know who is responsible on the team for certain things, because otherwise things fall through the crack or don't get done. I think that, how to, meet partners is one, we talked about at the time during COVID, a lot of the stuff was virtual and stuff. And whether it is through that kind of stuff, or if you are meeting people, like meetups and things like organically within your geographic area. And I think you have to like, kind of get out there and connect with people. And as far as like partners, I think it's important for us to know what value we bring, what skill sets we have, and who we can complement, what we're looking for as well. Because sometimes you might go out there and two or three people want to buy multifamily, and you're like, let's do it together. And then you realize maybe you're all great underwriters, but no one really has the people skills to talk to brokers or to talk to investors, or maybe somebody really likes doing that kind of stuff, but they're not great at the underwriting or finding an asset manager. And so I think understanding what am I good at, and sometimes we have to do some other things that are maybe a little bit outside of our comfort zone, or we need to learn the other roles, but that doesn't necessarily mean we have to be totally responsible for them all the time. And so I think understanding the value that we bring can kind of help us. Because if I just say like, hey, Jonathan, what can I do for your team? Then I'm putting the onus on you to figure out like, what do you guys need? Instead of saying like, hey, this is what I'm good at. This is how I can bring value to you. And you can be like, yes, we need that. Or, our team already kind of has that field. And so I think that's one thing, understanding, kind of how people, react when things, don't go well and stuff. And that takes time. You got to spend time with people, sometimes more than just at a meetup, having a dinner or whatever, getting to know people and things of that nature, because there will be challenges, whether it's, significant or just small day-to-day challenges where you kind of disagree on things.
Yeah, that's really well said. And just for benefit of the listeners, and some of you may already know this, but probably the two big things in syndication is acquisitions, finding the deals, or maybe three big things: finding the deals, raising the capital for the deal, and then running the deal afterwards. Right? That's kind of how the buckets I would put it in. And so, thinking through which one of those three that you fit in, like Marcus said, and then being able to go to an experienced sponsor and say, hey, like, I'm willing to go pound the pavement and talk to brokers or underwrite deals, or I have a good network of capital that could potentially come in future deals. And the one that I like the least when people come to me as a new investor is like, oh, just give me some shares on the deal and I'll run the asset after closing. Because it's one of those things that like most people in this business are decent at project management. Like I've done project management. Obviously, Paula, who does our asset management, extremely experienced project manager. Marcus has done project management. We've all done project management, right? But running a multifamily asset after closing as a new person is probably something like you need a little hand holding. And quite frankly, not everyone's good at it either. So.
Agree. Yeah, agree.
Awesome. So let's kind of just pivot generally, like what multifamily today, right? A lot's changed since you and I started in the business. We've been blessed to have a couple full cycle deals that have gone well, which is great. Buying more towards what I would argue is the top of the market to the bottom. But now we're kind of in this weird funk or stage of multifamily, which I see as an opportunity. But curious to hear your take. Like, is there opportunity? Where is it at today? And kind of what do you see people should be taking advantage of in the current market?
Yeah, it's great. And, as I do a lot of investor relations and education with and potential investors and talking to them. And those conversations, have shifted a lot in many ways over the past, 4 or 5 years. And not necessarily that, from our perspective, but like how people feel about the market, uncertainty, whether it's multifamily or just in general, and the conversations you're having with them, sometimes kind of shift. And, at the time when we were starting, like you said, kind of top of the market, there was a lot of offers on things. There was a lot of people using variable rate debt. Fortunately, we made some good decisions to stick with fixed rate. And we've seen a lot of those, operators kind of disappear right now. There hasn't been as much deal flow transactions going on. And now I think we're going to probably be at a point both because of, the number of loans that were taken out 5 years ago and some of them coming to the end, whether they're distressed loans or just, the natural time for those two. I think we'll start to see that transaction pick up a little bit. And as we've talked about recently some of the basis that we're able to potentially acquire some of these properties. And so where we focused a lot in some tertiary markets and have had some successful exits there and stuff, we're at a different point where we're actually able to get into some pretty compelling, you know, markets that we probably wouldn't have put offers in or been as aggressive on just a few years ago. And so I think that, in all the cycles we look back and stuff, and when people, we've talked about it before, how a lot of people comment that they wish they would have bought more in 2008 or those types of times. And sometimes when you're in those moments, it's hard to appreciate or realize the opportunity that exists there. But, we certainly still have to do the same, analysis, the same due diligence, same things that we've done for the past 5 or 6 years. But I think we'll see a lot more opportunities that 5 years from now, 6 years from now, people are going to wish that they had pulled the trigger on some of them to get in.
Yeah, no, I mean, I couldn't agree more. And it's funny, I can't remember if I've already said this story on the podcast yet, but, when I first started in commercial real estate, the first book I read was Commercial Real Estate for Dummies, right? And I remember I literally read it during my lunch break at work because I had a W-2 job at that time. And, it's like chapter 1 or chapter 2, it talks about timing the market. And truthfully, none of us can ever perfectly time the market. But the idea was just generally, if things are getting better, like you're at the bottom or things are starting to get better, you have a tailwind that's going to help you in your investment. And if you're near the top where things could turn and go down, like you're going to have a pretty bad headwind if you have to hold on to an asset. And that's literally what we've seen the last few years. And, we've been fortunate. We've been able to exit a couple projects successfully and probably have one or two more in the next year or so that will exit, I think, successfully as well. But there have been headwinds. And so, yeah, it's funny, all the things I've learned and done, I still go back to that all the time and just think that's probably the best bit of advice that I've heard in real estate investing. And frankly, here in another 3, 5, 7 years, whenever we hit the top of the market, probably sell a lot of stuff and go sit on the beach for a year or two and wait for it to cool back down. So
yeah. And I think, talk about timing the market and stuff, there's definitely better times to be buying and better times to be selling. But over the course of our first few years in multifamily, the past 5, we have pretty consistently made acquisitions each year and stuff. And I think that has also given us a lot of insight into, fortunately we're having successful exits on some of those. We've seen, the challenges that some of those headwinds can provide, but having continuously acquired during that time period, we've also seen how some of those acquisitions have changed. I think that's kind of what excites me about the point of some of the acquisitions that that we're looking at now.
I hope you're enjoying the content of this episode. I want to take a quick 15-second break to thank our sponsor for this episode, which is Apogee Capital. Now, Apogee Capital is our private equity firm that we allow investors to participate in large-scale multifamily investment opportunities through. If you're interested in being a passive investor and would like to learn more, you can find information on our website, www.apogee.com. Link is in the show notes. Now, thanks and enjoy the rest of the episode. Yeah, no, I agree 1,000%. It's like if you can go top to bottom and do well, like what can you do from bottom going up, right? Yeah, couldn't agree more. Yeah, so I think one thing that you're probably qualified a little better than me to talk about is markets. A lot of people really ask questions about like what market or markets should I invest in. This could be for active or a passive investor. And Paul and I are in our share of handful markets that many of them we share with you, but I think you're in even more markets than we are. How do you kind of assess a market, particularly maybe a new one, and see like, is this a place I want to be? Is it not a place I want to be? And, then kind of stay on top of it ongoing across multiple assets in those markets.
Right. Yeah, I think that, one thing is like the U.S. is a big country, right? And there are a lot of good markets throughout the country. And so sometimes when we kind of get started, particularly like when you're looking at like analysis and you're analyzing new properties and things like that, not just necessarily the market itself, but I think it's just a lot easier to focus on like one market, to get started, because you can become so much more efficient in understanding, the economics of that market, rents, taxes, all the things to analyze the property. And it's more difficult to do that if you're trying to analyze in 3, 4, 5 different markets. And so, one thing, sometimes people ask me, like, how are you in, 4 or 5 different markets? And one of the biggest things is partnerships, right? I am not necessarily focusing on the asset management of each of those individually. So in a lot of cases, like you and Paula do a lot of this stuff in Texas for us, right? We have partners that do, some asset management in Tulsa. I have stuff in Murfreesboro, Tennessee, where there are other asset managers there. And so I think that's one thing as far as how you stay on top of it is, building some strategic relationships where the asset managers are very focused. And even some of the partners that are doing the acquisitions from, relationship building with brokers, understanding what things are buying and selling for. And so through a couple of very strategic partners, like yourselves, I'm able to do that across a couple more markets. I think that, that's important to do. And as you're kind of like looking at different ones, I think that sometimes when people are getting started, especially, they might be trying to narrow it down to 4 or 5 markets to invest in. And, sometimes you get to a point where one of those may not necessarily be better or worse. It could be very similar economically, I think. But, what are the relationships that you have there to help execute, the business plan there as well. So
That's great. Kind of pivoting just a little bit, and something I'm curious to ask about is capital raising. So you've already mentioned that you're and for those listeners here, Marcus is good at a number of different things in real estate, as he kind of mentioned too. But specifically, working on the capital raise, finding investors, building relationships with investors. I think it's something a lot of newer multifamily investors are pretty apprehensive about it. I know that I was coming from an engineering background. I always joke that we took a grand total of 0 classes in sales or marketing in engineering, right? And so that was very new to me and took a lot of time, and still would not say hey, I'm the best or anything like that. So curious to hear what your take is, for someone that's newer, they're starting out and they recognize the value of using other people's money, how they can offer something to other people to help them, but also leverage their time and experience to do better for their families. How do you go out and convince investors to join a deal?
yeah, I think, and one of the things for me is I spend a lot of time with them, by having strategic partners like yourself and stuff who help in some of the acquisition and asset management. I try to bring value from a capital perspective in many ways. And so, again, going back to what I said earlier about what can I do to bring value to you, so you can focus on the roles, that you have. And so I think one of the things for me and the approach that I take with investors is just, like I said, lead with education and value, right? And so I spend quite a bit of time on conversations. Sometimes people want, to have kind of everything kind of automated and things, and that's nice. It makes things, but it's still a people business, right? And I spend a lot of time one-on-one calls or different things trying to do that, and really trying to understand what people's personal and financial goals are, right? So when I say personal, this kind of goes even to bigger real estate. There's a lot of real estate's a very broad spectrum of passive opportunities to active opportunities, things that create more cash flow versus things that, are bigger growth or equity. And so I think understanding what are their personal goals for their family, how active do they really want to be in it, or do they really want to be passive? And then also understanding financial goals, and do our investments align with those, right? And so, sometimes, I've had military friends that said, hey, I have a couple $100,000. I want to use it to buy a house in 2 years. Well, that's probably not a good fit for a syndication that has a 5-year business plan, right? Maybe I can connect them with somebody that needs private lending or something like that. And so trying to approach that from a fiduciary mindset, not thinking about necessarily getting their capital into my investment, but, how can I support them and provide them the best advice? And if it happens to be our investment, then it's a win-win.
Yeah, that's great. And kind of kind of peeling off of that, because I know you do a couple other asset classes like private lending. Not sure if you know or not, but I've become bigger in just personally investing in the stock market on the side in the last year, and I feel like if you can find asset classes that complement each other, it's really helpful. So, what are kind of the big benefits of investing in real estate versus maybe some other asset classes you can think of, whether that's private lending or stock market, and how can people kind of think through which one might be a great fit for them?
Yeah. So I think that one thing, is that I'll share for real estate in general when we talk about buying and holding things for any period of time. And some of your listeners may have heard this, but there's an acronym IDEAL, and you sometimes hear like real estate's the ideal investment. And so what that is I is income, so like from cash flow, the D depreciation, E is equity, like from debt pay down, the A, appreciation. So that could be natural from the market or forced appreciation, like we often do in our multifamily assets. And then the L is leverage, right? So you have the ability to get leverage to, acquire real estate. And so I share that quickly because, sometimes in the stock market and things like that, you don't necessarily have all of those benefits. Maybe there's
Right.
some cash flow from, dividends, or maybe there's some growth, but you're generally not getting leverage to go buy stocks, or, not taking depreciation on it, things like that. And so
Yeah.
I think that that's one reason I like real estate, is that you have the ability to make money in more ways, if you will, than some other asset classes. That said, there's liquidity or different things like that. And that's one thing we've talked about recently as we get into bigger properties and have the need for larger liquidity to acquire them. Maybe I can't hold all of that in real estate. And so I need it to be in stock market or something else that's a little bit more liquid. Similar to like private lending, it's usually a shorter term. So 6, 12 months as an example. And so someone that doesn't want to tie up their money as long, that might be a good option, that they can get a higher interest rate than, they're getting in their savings account, or perhaps even better than the stock market at times, depending on what they're invested in. However, it doesn't necessarily have the benefits of, the equity growth, appreciation. You're basically getting interest, right? Which is taxed like interest,
Yeah.
and doesn't have the tax benefits. And so understanding some of the pros and cons of each of these, and then thinking about like, what are your goals for that money? Like, what bucket of money is that in? What do you need it for? Does it need to be available and liquid, or not?
No, I really like that. And I like the acronym a lot because, for me, coming from corporate America, I was really kind of anti stock market for a long time because I didn't understand it. Obviously, you don't have as much control as you do over a piece of real estate that you own. And so I was sold in on real estate where, Paula and I, probably 95% of our net worth invested was in real estate. So definitely practice what we preach when we say we like real estate, we invest in real estate. But then the problem that I had is, as a guarantor like you on a lot of these loans, you need a certain amount of liquidity. And for a long time, I just had it sitting in a money market, which at one point was making like 5%, and now it's like 3.5%. And you start talking about the liquidity requirements in some of these loans, it's a substantial amount of money that's essentially just getting enough interest to fight off inflation, and that's about it. And so that's where kind of the stock market came back in play for me in the last year. But the two negatives to it is one, the taxes, right? So you don't get any depreciation when you invest, and then when you sell, you're subject to capital gains. And if you sell in less than a year, short-term capital gains, or rather, income tax, which is more expensive. And then leverage, right? Now, there are ways in the stock market where you can use margin options and things like that to essentially leverage your investment. But I would say the risk, like, there's a thing called the Sharpe ratio, and the risk that you take on to get those kind of returns is significantly higher, in my opinion, than the leverage that you use in real estate.
Right.
So yeah, that's interesting. Yeah, so I want to kind of just pivot the show a different direction the last few minutes here. So your company's called A Long Legacy, which is obviously a bit of play on words, and that's cool because I kind of did the same thing with our company name. But let's talk about legacy, right? I think one thing you and I have in common is like we both want to go out, do well for ourselves, for our family, make a lot of money in real estate, certainly. But we both really care about helping people, about helping our kids. How did you decide to name your company that? And like, what are some ways that you give back, or like, what's the lens that you see investing through as the owner of a long legacy?
Yeah, no, I appreciate that. And it's kind of it's been a little bit of a journey even since I named the company and over the past few years. And so when I started a long legacy in 2020, and that was around the time of that I was talking about transitioning, kind of looking at multifamily and transitioning for my post-military career. And so that's when I started it. And of course, like you said, to play on the last name. And ultimately, the original kind of thought and stuff was, creating a legacy that we can kind of leave behind. I left the military a lot for the kids and thinking about them in the name and the legacy I have for them. But when I say it's been kind of a growing journey, like since I named it, I thought a lot more about like living your legacy today, right? Not just like building this legacy to leave later on, but like live your legacy like today. And so I think that's kind of an approach I've really taken over the past couple of years specifically, is like what the actions I take today like helps create that legacy, right? It's not necessarily just like the money I leave behind to them or whatever that might be, but it's really more about how I live my life today as a husband, as a father. I'm on the board for a nonprofit, so that, I guess that goes into your question of other things that I'm doing. We're a pretty active board. We build homes in central in America and other things throughout the U.S. as well. And so for my kids and for the people around me to see me going and doing that and giving back, I'm pretty involved with stuff at the church. And so I want to be an example, like for my wife, for my kids, for my neighbors. Sometimes it might be just how we treat our neighbors, right? Like literally how we treat them, smile, wave as we go by. It can be simple things like that that kind of create the legacy of who we are and how people remember us, right? And so that's kind of a lot of the background on, the growing thing about how I think about legacy and, how that kind of translates to some of the investing stuff too, and how I want to help other people is, I want to provide them an opportunity. Money provides options for us to do things, whether that is for them, it's a tool, right? So whether they want to give back to an organization, whether they want to have the freedom to go travel with their family, whether they want to be able to do something that doesn't require them to work as hard for money, their W-2, whatever it is that's important to them to give back. That's part of what I want to try to help enable, is to, help them build their wealth in a way that they can do that and have options.
Yeah, I really like that, and thanks for taking the time to explain that. Obviously, we don't have kind of the same meaning in our name, but I would say kind of our mission statement and stuff at Apogee is about helping passive investors live their calling, which is kind of the same idea, right? And
Right.
I like that you mentioned, because I grew up in a kind of a subculture where it's like people that had a lot of money they weren't necessarily bad, but they weren't really viewed as good either. It's kind of like they're probably not doing the right thing or something. And I think it's, at least in my view, it's important to remember that like you say, you have options when you have money. There's things that you can do. There's ways you can help people, not just giving money, but with your time, when you have the time to go help, that you can't do when you
Right.
don't have those options. That's one thing I always talk to our investors about who have those kind of questions, is like, having yourself taken care of financially then affords you not just the money, but the time to go out and do the things that you want to do for other people. Because most of the investors I know, they really want to go help other people. They want to do something and have an impact. If you ask 10 people on the street, like, do you want to have a positive impact in your life or not? 9 out of 10 are going to answer yes, right? But it's like,
Absolutely.
what are you doing to set yourself up for that success?
Yeah. Yeah. And that's, when I mentioned like live your legacy, it's kind of an action statement, right? Like to go do something, but we have to, I shouldn't say we have to, but like it is easier for someone to make a decision to do those actions and stuff if they are in a position of comfort, where they're not worried about the paycheck for next week, or, taking off a week to go volunteer somewhere, whatever that might be. And, so I want, people to kind of think about action steps or action and how they live their life.
That's really cool. One final question in closing. This podcast, it's really designed to help people, whether they're active or passive, get started in real estate. A lot of the lessons you and I maybe had to learn the hard way, or if we were lucky enough, we learned through mentors or peers, to try to avoid some of those hard lessons. And so someone's just getting started in real estate today. What's your best advice to them? What would you tell them to go do?
One thing I think probably that is important for people to know, and I kind of mentioned it a little briefly early on, is understanding the spectrum of real estate strategies and the benefits that come from each, right? Because, sometimes we might only know single family long-term rentals, or we might only know flipping houses or whatever based on the network that we're in. But there are a lot of strategies that are available, and they have pros and cons depending on how active or the cash flow and everything. And I think sometimes we might end up getting into a strategy or something that doesn't really align with what our goals are. Like maybe you start going flipping, and the next thing you know, you get a big paycheck and you like that, and you have to flip your next one. You're like, well, this isn't really what I wanted to do forever, but and that could apply to any strategy. So I think learning and talking to someone that can kind of talk through those is important to know, so that you may start in one and shift to another, and sometimes they complement each other. But just having a little bit of that kind of understanding is one. And the second one, real quick, I would just say is to seek out mentors, and not just like, hey, will somebody be my mentor, right? Like anyone that is probably worth being your mentor is probably busy, or running their own business or whatever else that might be. And so whether it might be a paid mentor, or how can you provide value to that mentor in exchange for their time, right? So, again, not just asking for a handout as a mentor, but trying to shortcut some of the tough lessons that you could have just asked good questions, or shadowed and things like that, to learn some of those. But remembering that you have to provide value back to them in some way, shape, or form as well.
Yeah, I like that. That's great. Marcus, really appreciate your time today. I think myself, the rest of the listeners are better for it. If someone wants to get a hold of you, what's the best way they can reach out and connect?
Yeah, if they want to reach out, they can go to alonglegacy.com. So from there, you can schedule a call, send me an email, has a link to socials. You can check out, our company and the portfolio and stuff like that. That's alonglegacy.com.
Awesome. Marcus, thanks for the time. Thanks for joining us. And all the listeners, we'll see you back next week. Thanks for tuning into the Apogee Wealth Podcast. I certainly hope you found something valuable in this episode that you can take with you and apply to your own investing journey. If you found the show valuable, you can subscribe so you don't miss further episodes. And if you'd like to learn more about ourselves or our company, you can visit our website, www.apogeemfc.com. We have a ton of educational resources that I'm sure you'll find quite valuable. Until next time, happy investing.